Hello and namaskar viewers, I am Sanjeev Pandya welcoming you to this week's edition of the Business Talk with AJ right here on ITV Gold. Happy to have you join us in this episode and all along in this entire series called the Business Talk with AJ. This is the show brings you in-depth information about any business, mostly South Asians who are engaged in the business. We give you in-depth information what the business is all about, how you can make money, what are the pros and what are the cons, and how you can make the business very successful. These are the things we discuss, and of course it helps us because Mr. AJ Kumar of Sai CPA Services gives his input, gives his valuable input based upon his knowledge and experience in this show, and that's what makes the show very, very interesting. The show is brought to you by Sai CPA Services, a full-fledged professional accounting firm located in the state of New Jersey with multiple locations. Not only taxes, but they can help you in a wealth planning, investment planning. They can advise you in that matter as well. And this may be the right time to contact them before the end of the year, so that way you can plan putting your money away, invest your money such a way so you can reduce your tax liability. And other than that, any tax matter, personal or corporate tax matter, you can give them a call at 908-380-6876 or visit their website saicpaservices.com. With that note, I'd like to welcome Mr. AJ Kumar. AJ, good to have you, and thank you for being here.
Absolutely. Thank you, Sanjeev. Appreciate
Sure. It. Very well. As we continue to give so much information on various businesses, now let's look into the other side of the business. When I say other side of the business, that means number one question is, how much is your business worth? That means, how much is the business worth depends upon a business valuation. You may hear stories in the news that this company was bought by that company because the valuation was so much and the valuation was so much. How does the valuation work in the businesses, and what are the key points to have your business valuated, and so that way you can build up a goodwill and you can have a higher price for your business? So we're all going to discuss that, and AJ is going to give us a lot more information. So AJ, first of all, how important is a valuation?
I think it's extremely important for a lot of small business clients. As much as we are all working hard to feed the family, at the end of the day, this is your baby. This is what you have created all your life. When you retire, if you can sell it off, if you can get some money out of it, this is your retirement plan. Government is not going to give you any pension. Your business is what is going to feed you after you have left the business. And from that perspective, knowing what can change your business value, how do you increase the business value while you are working on your business is extremely important. If you can understand those factors, if you can learn those factors and consciously work on those factors to improve the business value, then by the time you retire, you are sitting on a golden egg. And you retire, you have some money, either you sell it on an installment plan, you sell it outright, and you have X amount of money that you can use for your retirement.
Okay, so that is the important part of it. Now let's talk about mergers and acquisitions, because these are the things really happen in the businesses. Either they merge or either they are acquired by so-and-so, right? Or either they are purchased by so-and-so. So now let's go with it. With the mergers and acquisitions, what are the key points?
Absolutely. So if you take a step back, a lot of businesses acquire other businesses. A lot of people retire and they sell their businesses to other similar businesses, and the concept is referred as M&A, mergers and acquisition practice. In a typical M&A kind of situation, we look at synergic value. So for example, let's say if I'm trying to sell a CPA practice, my practice has more value to another accountant than to somebody who is not an accountant. So if somebody who is not an accountant try to buy my practice, they're only looking at the cash flow, but they may not be able to retain a lot of intangible assets, a lot of clients. But if another accountant is to buy the accounting practice, my practice, not only they will be able to retain a lot of clients, they can create something bigger. In this case, 1 + 1 could be more than 2, just because there is synergy involved. So when we look at an M&A type of practice, we typically look at synergic value. You have to understand what creates synergic value. You have to understand how agile your system is. Can your business survive without you being there? Or are you the bottleneck in your business? From that perspective, when you look at M&A type of business valuation, the key that you want to learn, that you want to understand, you want to make sure you have enough technology, enough resources to make sure your business can run without you being there. If you have to be there, your business is not worth anything to me. I cannot run it without you. So what would I do? If your business is automated in a way that you can be there for n number of months, n number of years, and then I can easily take it over, your business is worth something for me now.
All right, so this is what they look for it, that, who is your backup plan, who is going to be running the business in case of something happens to you.
That's right.
They just don't like to have one person in charge of their business 24/7.
100%.
Okay, all right. So there you go. Anything else you'd like to add in merger and acquisition, stock transactions or something?
Absolutely. So depending on the size of the business, a lot of smaller clients that we see, mom and pop shops, they typically don't have the stock transaction. Either they will have the equity sale or APA, asset purchase agreement. But if you are looking at the theoretical concept of it, when you have the stock sales, especially when you are looking at the block sale, meaning a lot of stocks are sold at the same time, then you want to look at what's the stock value. The stock value is $10 per stock, but I'm selling 10 million stocks. Do you get 10 million multiplied by 10? Probably not. Because once you put 10 million stocks in the market, the stock price will suddenly go down. So that's when you start looking at fair market value as opposed to synergic value. So in a stock transaction, typically you get lesser money as opposed to a typical M&A for a mom and pop shop, where we look at the synergic value, where you get more than the fair market value.
Okay, interesting. So after merger and acquisition, and now let's move into litigation process. Business valuation and of course litigation also an important part of it. So what are the important points?
You're right. It's unfortunate, but it happens all the time. People get married, people get divorced, and we'll talk about divorce as well. But let's talk about the shareholders litigation, when you have 2 partners, 3 partners, and they want to move on their different path. Now they have a business that they all created, and now they want to split it out somehow. They want to create a valuation. The problem here is a lot of time the business needs both of them to survive. When one partner is moving out, or both partners are moving in their separate way, both partners are suffering. So in this case, 2 divided by, when we have 2 ways, it's not 1 and 1. It's always less than 1 and less than 1. So in a synergic value, when we say 1 plus 1 is more than 2, in a typical stock transaction, in a shareholder dispute type of transaction, when you divide 1, both partners get less than half, meaning the value get diminished because the business was created, needed both of them to survive. So in that case, we look at the fair value, not the fair market value, which typically is less than the fair market value. So in this concept, we look at what value each person brings, and we try to give the business what they were managing. And then the important part, then we'll have some non-compete around it when we look at the stockholders dispute type of valuation type of exercise, that when you have this contract, you must have some sort of non-compete around your area. In this case, the key is, it's a good deal when both parties feeling that they did not get a good deal. A good deal means both of them are feeling they did not get a good deal.
Okay, so these are the things in the litigation, and you did touch upon divorce proceedings and everything. So the divorce can be part of it also.
Absolutely, it's very, very similar concept, Sanjeevji. In a divorce case, husband and wife were working together. They had some intangible assets, some business that they were running. In many cases, businesses are being run by one spouse, and the second spouse is in the supporting role. That does not mean the second spouse does not get anything. In a common state, depending on which state you live in, they both have certain rights to the business. Even if their ownership is not equal on the business, the spouse will still have some value on the business. So in this case, we'll typically go with a fair valuation. The theory is again very similar to the shareholders dispute, where 1 divided by 2 is not half and half. They both have less than half, and they both feel that they got less than what they were supposed to be getting.
All right, these are the things to be careful under this litigation and the dispute category. Now, merger and acquisition, and then litigation and dispute, and the other important part is bankruptcy. when it comes to business valuation, right? Financial restructuring and bankruptcy. Bankruptcy is not always bad for a business, especially if you're in a restructuring process and if you really have a potential to make the company viable in 3 years, 5 years, 10 years. It's still worth a business. And then a lot of companies do purchase bankrupt businesses because they look at the plan, say it's a viable to get it. So in just a 1 minute or so, AJ, just tell us very important point under that category.
Absolutely. So in a liquidation type of scenario, we don't look at fair market value, fair value or synergic value. Here we are looking at replacement value, liquidation value we call it. It depends on chapter 7 or chapter 11. I mean, it's not a legal show, but bankruptcy is not all that bad. If you are restructuring your business, as Sanjeevji rightly mentioned, sometimes you get ahead of the game because you had some debts that you can restructure, you can pay less than $1 for $1.
Yes.
And in that case, it gives you some breathing room to survive, to come back on your feet again. So in a typical liquidation, bankruptcy kind of cases, we will look at replacement value. If you were to replace this asset, how much can you sell it for? Or if you were to liquidate this business, what could you get out of this business? And we refer it as a replacement value or liquidation value.
Very important points that we covered so far. With that note, we're going to take a short break. When we come back, we got a lot more coming up your way in this episode. It's about business valuation part 1. Stay with us. Welcome back to the second half of the Business Talk with AJ. This week we are discussing business valuation. AJ Kumar, CPA and MBA with Science CPA Services for over 30 years, is giving us in-depth information on this business valuation. Business valuation is very, very important for your business. Whether you have a small business, mid-sized business, or even a large business, you know business valuation is very important. And to have a right person to value your business, that is also extremely important. And for business valuation matter for your business, if you need any assistance or guidance in that direction, you can definitely contact Science CPA Services. Just ask for AJ Kumar at Science CPA Services regarding any matter but business valuation also, and they will guide you. They can be reached at 908-380-6876. All right, AJ, before we continue where we left off in the first half, my question to you is, I heard you saying a couple of times fair market value, fair value, shareholder value. Why are these values different, and what is the main purpose of these different values?
Absolutely, I'm glad you asked. I should have clarified it earlier, Sanjeevji. So there are 4 main type of valuation that we are looking at. Fair market value is basically what a typical person will pay for that type of asset in a fair market, in the sense when there is nobody is pressured, it's a fair game, arm length transaction. How much is somebody, hypothetical buyer, willing to pay? A fair value is not same as fair market value. A fair value is typically seen as a specific situation, a specific buyer, meaning in a divorce case, we look at a fair value, because what a spouse is willing to pay or willing to give is not going to be same as someone else. So in a typical shareholders dispute, 2 people are working together, what they know about each other, what they know about business is not something that a hypothetical third party will be willing to pay. So we have a situation where we look at fair value, not fair market value. Fair value based on certain hypothetical exact situation for this person only. Then we have synergic value, where we see some synergy between the businesses, typically seen as M&A type of practices, when an accountant is buying another accounting practice, a grocery store is buying another grocery store, so they can easily absorb the inventory. If I were to buy another grocery store, it's not the same value for me. I don't know how to run the grocery store. But if I were to buy a CPA practice, I can easily take those customers and merge them into the same practice. So I see some synergy. That's synergic value. And the 4th value we talked about in the bankruptcy case is the liquidation or replacement value, where we assume all the assets are being liquidated, sold out or replaced. In that case, what would be the valuation? So they are typically high level.
And they are all important depending upon,
depending on the situation.
Depending on the situation and the business. Okay, now let's continue this business valuation more. We covered about 3 points earlier. Before the break, we're going to continue to cover more. How does the gifts, and the wealth matter comes into business valuation?
Absolutely. If you take a step back, gifts, you don't really, large gifts are not given to a third party in the market. There is a related party transaction. gifts are given to the next generation,
Yes.
the family members. So in a estate and gift type of situation, we'll typically use fair value as opposed to fair market value. In this case, the valuation is important because the government gives certain quota, certain amount of money that you can give to next generation. Right now is 13.6 million unless you do Form 706 filing for portability transfer. In that case, you can add the spouse limits, but 13.6 million amount, lifetime amount, can be given to next generation, can be gifted to the next generation tax free. If you have a business worth more than 13.6, then you have to be concerned about tax planning, that you have to be thinking about tax planning in advance. So from that perspective, valuing the business is very important. You value the business based on fair value standard, and then you see 20% goes to my son, 20% goes to my daughter, my total business is worth $10 million, so 20% is 2 million. No, that's not how it works. Because the person who is getting 20% cannot make business decision. In order to make business decision, you have to have at least majority ownership. So the person who is getting less than majority ownership, does he have the same valuation? Probably not. So there are a lot of creativity goes into these valuations when you come up with these numbers. But typically in a gift type of transaction, in an estate transaction, valuing the business properly is extremely important.
Okay, very interesting. So I see you basically covered, with the gift and the wealth, you covered estate planning as well, because
absolutely.
Obviously that also comes in effect.
100%.
Now let's quickly move on to the next one, which is business interruption claims. How does that work in a business valuation?
Well, let's think about it. Something happened to the business. A flood happened, or the water pipe broke, and now you cannot run the business for 6 weeks. You want to go to insurance company to file a claim. Well, what's the value of that 6 weeks business interruption? You have to have a valuation guy coming in who will look at the potential cash flow that you are getting, the cash flow that you can still get because it's only delayed, not lost, and then the cash flow that you will not get. There's an opportunity cost, there's an intangible cost in this type of situation that's built in. So you will be looking at fair value transaction, fair value of the valuation method to see what did the business lose by not having the proper service, by not being able to serve the clients, and the opportunity cost, the cash flow cost is built into this business interruption valuation claim, and typically used when we go for the insurance company. Insurance company will need a certified valuation expert to be signing the report.
But this is one of the least likely thing, very least likely.
It depends on the size of the business.
I know, and then depends on the location of the business.
Depends on the location, depends on the size. It's not as uncommon, actually.
Correct. Okay. All right. Now let's go to the next one. As you know, AJ and everybody else, that today's business really thrive upon customers' reviews and their comments and everything. Everywhere you go, they want to have customers' review and so on and so forth.
Absolutely.
So with the customer review comes in a reputation.
Right.
What about damage to reputation or goodwill comes in a business valuation?
Absolutely. If you think about it, say we do the TV show. We have Google reviews. We have so many clients talking good things about us. That creates a persona, that creates a feedback in the market. These guys know what they're doing. If that reputation is damaged somehow, the new client is not going to be coming in. So the question is, how do you measure such a thing? How do you decide how much is the loss to reputation? Or if somebody is putting a bad review for you, what did you lose actually? The theory behind this thing is you measure the cash flow, how much cash flow or how much growth you were getting prior to this incident, what you have lost, what cash flow do you have now, how many customers are not coming into you right now, and is this a temporary thing or is this going to last for some time? Then you try to value the difference between the cash flow for that duration that you estimate this incident,
loss of business,
or reduction of business,
basically, yes.
is to last. And based on these two methods, initial cash flow versus the new cash flow, the difference between the two, based on the duration, you try to calculate the damages based on the reputation that you have lost. So, and that's how you claim, and that's how this is typically used in the legal cases, in the court cases.
And also restaurant business, and
it does happen
where there's a a lot of retail businesses.
Absolutely.
All right. So now let's talk about business growth and expansion. If somebody has planned for business growth and expansion, in valuation, you also add that point as well.
Absolutely, 100%. As we were discussing initially, you're growing the business. Wouldn't you want to know what factors help you grow the business? And as much as we want to tell you do this, this and this, it's all case sensitive. It depends on your business type. For an IT consulting company, the factors are completely different than the restaurant, grocery store and accounting practice. In some cases, reputation is extremely important. In some cases, it's important but not as important. When you look at the grocery store, do you really care about the Google reviews as much as you care when you go to an accountant? So for each business, the factors, the drivers are going to be different. But when you are thinking about your business growth, expansion,
is very
make
important.
sure you know the factors.
Correct. Yes.
What helps you grow your business, what helps you improve the valuation for your business, so you can consciously work on them and eventually either go through M&A, exit plan, sell the business, give the business to the next generation. All of them, it will help you get to the next level.
All right, quickly, we got 2 minutes, less than 2 minutes left, and we got 2 points to cover. Sale of business. When somebody is trying to sell the business, obviously that also comes in valuation that, the owner wants to sell the business in next 1 to 3 years or something like that.
Absolutely. So think about it. When you have the right valuation in place, you will get more money for the business. We come across a lot of clients. I want to show more profit. Why? Up until yesterday, you were fighting with me to show more expenses. Oh, I'm trying to look for an exit strategy. I want to be selling the business 2 to 3 years. More profit you show, more revenue you show, more cash flow it creates, and more valuation it creates for your business. So you will find yourself in a situation where people know that they will think about an exit strategy. They want to sell their business in 2 years, 3 years, and you have to start this plan a little bit in advance, 2 to 3 years in advance. You can't really say, I want to sell my business next month, what can I do now? If you have 2 to 3 years, then you can plan it properly, plan it right, improve the business valuation, and then get a buck out of it.
Now, last point, when you really plan it well and everything, the last important point, which is obviously one of your favorite, taxation. How does the tax issue affect in the business valuation?
Actually, it helps if you do it smartly. More money you invest into your own business, less taxes typically you end up paying. It depends on the business type, it depends on the legal structure of your business, but the theory behind it is more assets you have, more diversified your business is, more depreciation you can claim from your tax perspective, and more cash flow it creates because you have more assets creating the cash flow. Cash flow is created by the assets you have in the business. So if you do it smartly, a proper business growth strategy will help you save the taxes as well.
All right, 1 minute to go, and one last question I have. When do you think business owners think about having their business valuated?
A lot. It depends on the personality. I mean, I have seen people doing the business valuation every year just to make sure they understand how the business is doing, how the business is growing. And I have seen people doing business valuation only when there is a need, when they are going for a will and estate, when they want to create a trust, or when they have a legal dispute, or when they have a shareholder dispute, or when they have when they have a divorce or a situation that's forcing them to do business valuation. But the reason we are having this episode is to help you understand. You need to be knowing the value of your business. You need to understand.
Year. So basically
every year, every so often, you need to know, not because somebody is forcing you.
Correct.
So you can improve the value of your business.
If you're sincere about business, then do it every year.
Absolutely.
With that note, we come to the end of this episode. Once again, viewers, any question you have regarding this business valuation for your business or any tax-related matters, do contact Science CPA Services 908-380-6876 or sciencecpaservices.com. AJ, with that note, I'd like to thank you so very much. I am Sanjeev Pandya, wishing you all happy days ahead. So long.
Thank you.